Hi traders, and thanks for tuning in, where today I'm going to be discussing all about correlation trading. Now, correlation trading is another key way of having successful trades, as well as technical analysis, which I already discussed, and fundamental analysis. So now I'm going to be telling you all about what correlation trading is. Now, correlation trading is an investment strategy first and foremost, in which the investor utilizes the tendency of stocks to move together in order to minimize risk exposure. Now, why it's good is for diversity trading and portfolio. An advantage is that it minimizes risks. A hedge against drawbacks, missing out, or something, and it leverages profits. So it's worth conducting correlation trading. Now, what should investors do exactly with regards to this type of analysis? Well, you can sell a call option on the index and buy a portfolio of call options on the individual constitutions of the index. You can sell a variance swap on the index and buy the variance swaps on the individual constituents. This particular kind of spread trade is called a variance dispersion trade. That's variance dispersion trade. And you can sell a correlation swap. Now, oil and the Canadian dollar, as well as gold and the Australian dollar and US dollar, are good examples to discuss here. Now, oil and Canadian dollar, why exactly? Well, because Canada's the main exporter of oil. When oil's expensive, the Canadian dollar drops, and when oil's cheaper, the Canadian dollar goes up. Likewise, when there's a demand for oil, the price of oil goes up, and the Canadian currency goes up if there's more demand for oil. If you're struggling to understand this, you can imagine it as a fraction with the Canadian dollar on top and oil on the bottom. When the Canadian dollar rises in oil, the whole thing drops. The Canadian dollar and oil is negative. When one is up, the other's down. If dollar and Canadian and oil is inverse, the Canadian currency goes up if more demand for oil goes up. Canada currency, I repeat, goes up. Now you can take it further with the Australian dollar, as Australia is the main exporter of gold. If we see a stronger Australian dollar, we will see a drop in gold and the US dollar will go down. So here's a fraction. The US dollar or Australian could be on top, Canadian dollars on the bottom, or the Australian dollars on top or US dollars on the bottom. Here I've put the Australian on top, and at the bottom, the whole thing rises when it drops. So Canadian rises in oil, and the whole thing drops. It's irreverse correlation trading. Here's a graph. You can use graphs, they're very helpful in correlation trading. It's the oil versus USD CAD. And I've got this from BabyPip's site, but you can find them on Google if you just put in correlation trading graphs. Now, great events for correlation trading are monetary events. They offer such great trading opportunity because there's negative currency index on a monetary policy event. The correlation between currency and index is negative. Negative currency index on a monetary policy event. So if monetary is up, the index goes down. Australia and China is also very good examples. Most traders don't actually know how to trade China news. So if you know how to trade China events, then you're going to do very well, especially if you learn how to crack correlation analysis. These events are great for trading opportunities, such as HSBC China. It's a good indication from China of what's going to happen to the Australian dollar. Why? Because Australia is the biggest exporter of goods to China. The two assets are in correlation of one another. Positive when both assets move in the same direction, and negative when they both move in opposite direction. Now, thanks for listening to Correlation Trading Video 1. Stay subscribed for more videos on our YouTube channel at RBoptions. Thanks for listening, guys, and have a successful week of trading. Take care for now.